Hi, Edward. Welcome to the Investor Talk. Thank you for coming.
Thank you for having me.
My pleasure. So let's start giving a short introduction of yourself if you want.
So I'm Edward Kliphuis. I'm a Dutch national. I'm a scientist by background. Have been in ventures since 2009, and currently I'm a partner at Sofinova Partners. Now, Sofinova Partners, if you don't know about us, we're the oldest independent life science investor in Europe. 2.5 billion under management, purely dedicated to life sciences across various different strategies. So we invest from early stage therapeutics, late stage therapeutics, medical devices, life science solutions in industry, cell and gene therapy, as well as digital medicine.
Thank you, Edward. Thank you very much for coming. I'm very excited to cover these topics with you today. Uh, Let me start with this one. In which area and geography do you prefer to invest?
Look, we're global investors. I mean, the reality is Europe is our home. And when you look at, for example, Sofinova as a platform, we have more than 20 languages on the platform. All the main European languages are represented. We have 80 nationalities on our platform. So we like to think that we have very deep access into Europe and therefore have an ability to source deals early across Europe. That being said, we've made investments Europe, Israel, United States, so global.
Thank you. And how much do you normally invest?
Again, it depends. It's a multi-strategy platform, so it depends per strategy how much we invest. The strategy, which I guess the early stage therapeutic strategy, makes investments in seed and Series A. So these are tickets, ranging from on the lower end 1 to 2 million to on the upper end 10 million in a single go. Our late stage fund does much larger tickets. And then we have a medical device incubator that can really take smaller checks and take operational responsibilities in the company. We have our cell and gene therapy strategy, which again does investment sizes from anywhere between 5 and 10 in a single go. And personally, on the digital medicine side, we write checks all the way on the lower end in pre-seed companies from 500,000 to 3 to 8 million as a single first investment, with exposure up to 20 million for a single company. Now, these are confusing numbers maybe, and it's a lot of numbers I rattle out. But let's, if you take a step as to why, we are a multi-stage, multi-strategy life science investor. So we want to be able to invest and help founders whenever we spot a good opportunity and bring those companies forward. And that's why we are very flexible in how we can play the market and how we can address the needs that founders might have.
What about I think sometimes funders are a little bit confused when it comes to investments and follow up. No, uh, are you follow? I'm pretty sure you do. Do you follow up with your investments?
I love that you're asking that, because this is a massive gap in the market at the moment, and something that you really need to be cautious of. So I'm going to take a bit of a roundabout way to answer this. The simplest answer is yes, we carry reserves. Every single one of our strategies carries reserves for following on. Now, as a founder, whenever you select, for example, an investor to work with, I think it's important to understand what the investor represents and also what that means for your startup. So the way that we like to think about this is, personally, I look at a company usually as a multifaceted equation. So my first question is, what is the technology? The second question then is, what is the goal? Where do you go? And then the third question is, how do we get there? Now, the third question implies a lot of different things. It implies the team that is supposed to bring technology all the way to market. It implies the cash needs, because a funding round is usually nothing more than a request for time expressed in money. So it basically implies the cash need and the time need. Now, all these things added together then give you a sense of what this company requires to get to a point that we like to think is an end goal that is satisfactory for all the stakeholders. Now, that then comes to the next question, and that is, okay, so if you invest, let's say 5 million in the first round, but we now see that you will need 15 million in the second round and maybe 80 million in a third round, how are you going to get there? How are you going to construct your journey in such a way that you will get a de-risking and value creation at each step of the way to be able to request more funding? And where are we going to get the money from? Now, for us, for instance, we like to support our companies because we think it's very important to signal that once we are on board and the company achieves its goals, we are there to support the company going forward. But we also have within our limited partners, so people who invest in us, within our whole ecosystem, we have very deep pocketed investors that want to follow on. So we signal as a life science specialist, sort of a beachhead. We come in and we say, we validate this company by investing and we bring this technology forward. And that de-risks a company for the follow-on capital that also sits on our platform. And so with that whole journey in mind, you can then start to fill out those investment rounds and understand where the capital will come from. Now, by contrast, if you take capital, for example, from an early stage investor who runs a micro fund, a single GP micro investor, you can simply not expect that investor to follow on because they will not be able to. And again, there's nothing wrong with that strategy. It's just a different strategy. So as a founder, I think you really need to ask yourself, what do I need? Where can I get it? And how does that ultimately reflect the construction of my funding round that I'm currently going for?
I do agree. I mean, there is a lot of confusion when it comes to follow up and covering all the way up to some kind of exit for the VC, for the founders to succeed. What are the top concerns? Where do you find conviction when investing the company, the team, the product, for example?
Look, I started off in this journey when I started in venture more than a decade ago. I always read all these posts and I'm like, okay, so it's team, team, team. Then I went down the rabbit hole of it's all technology, and now I'm back. It's all team, team, team. Don't get me wrong. Technology is very important, and we are specialist investors, and we invest in a very highly technical field. So we always look at the technology, but ultimately it is a team that brings things forward. It is a team that is able to ask the right question, that addresses the right, the right technical issues. Now, the reason why it is team, 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 it is not that you can have any team and then, get like a massive valuation or whatever. It's always an interplay between the two. But what a good team does is basically run a company in a way that can be nimble and have an end goal that is value created for all the stakeholders. To give an analog there, think of it this way. We are investing. A company is a ship. It's like a ship. In the early stages, it's a very small boat with a very small crew. And so there's one captain on the ship and maybe one deckhand. Now, if the company goes forward, of course, that team has to grow, but you have to recruit those people. You have to tell people, like, come on board my ship and come with me on this journey across the ocean. So that's the key bit of a team. Then secondly, the captain needs to know where to go, because as venture investors, we are not on board that ship all the time. We check in a couple of times a year, and we simply can't because we have a portfolio of 20 companies. So we cannot be operationally involved to that level, even though we want to. Now, that means that there is a very important responsibility on the team to execute on all levels of this, to execute on navigation, to execute on being, responding well to challenges, to execute on getting the right crew members, to execute on making sure no mutiny occurs, etc., etc., etc.
There are so many people who say idea, shape, execution are key. What do you think?
I mean, again, it is if you look at a funding round as a request for time expressed in money, then you basically ask for a finite amount of time with a budget to execute something in to create value, which is supposedly a multiple of the money that you request, because otherwise why would one invest? And so execution there is key. Of course, you need to be, if you present a plan, you are accountable for that plan once you sign the documents, and you are then accountable for the success of that plan. Now, this sounds very almost draconian, like, you have to do this, but it's in the best interest of everybody, because accountability and dependability is very important, not only for the founders, for the C-suite later on, but also for the rest of the employees. If people know their responsibilities and they can manage their responsibilities and can create value by doing that, that's when you're on the right track. So yes, execution is a very, very, very important part.
Thank you, Edo. How important is face-to-face when it comes to investments? If, for example, is not being geographically close to the fund a limitation? And may I ask how often you like to meet the founders before and of course after investing?
This is a hard one, right? Because If you asked me this before the pandemic, I would have said unequivocally, in person is the most important thing. Now, I think we can mitigate that nowadays. We can say, actually, there is an argument for virtual. But virtual creates, visibility through a lens. And so you do not get peripheral vision. What I mean by that is you can do a lot virtual. You can meet a person. You can have an idea of what the ambitions are. You can understand the business plan. You can understand where the company wants to go. But there comes a point in which you need to understand exactly what this whole equation means in reality. So there comes a point where you really need to meet the person, where you really need to understand the team. And even if you think further, like in a seed round, you want to understand exactly who is this person that sits here with me. And for me, for example, those are, I like to go out for dinner with founders and just understand how do they treat the waiting staff, and how do they, for example, treat our assistants when they come into the offices. Those are important things because those are things that reverberate throughout the organization. If you're asking me something, in this case as a representative of capital, then it's easier to sort of like be all nice and salesy. But on the other hand, if you are not able to, for example, treat your staff in the right way, your staff is going to walk, and that's a massive risk for an investor. So we need to assess that side as well. Now, if you think further, now you, for example, are in a series A or a series B, you're going to have laboratories like in life sciences. We need to know that those laboratories are there. Just to put a very simple thing, you ask, there's a request for, a sequencing machine. We need to know that that sequencing machine has actually been bought and is really there in the laboratories, because that's the responsibility that people like we have, again, to our investors, that the money that we have been entrusted to invest in companies is not used to buy private jets and yachts, but is used to actually further research, build companies, and get value out of them.
The pandemic brought some change, but face to face is still extremely crucial.
It is.
How involved did you get with your portfolio? And let me ask, how do you add value to the investments? So many founders ask me how I can make sure investors does give me only, they do not give me all the money, but actually they help me because I need help.
So before describing and going in a sales pitch here, advice to founders would be do diligence on your investors. And the best way to do that is simply call up founders that they've worked with in the past. Ask them, because anybody can tell you anything, and they will tell you the world's best stories. But do your diligence and ask for introductions to the founders that they worked with in the past. If the investor doesn't give you those introductions, that's a red flag. And even go beyond that and go direct to those founders yourself that the investor has worked with. Do your diligence. Now, how we like to think that we add value, we're lead investors first and foremost. So we come in early. We are a lead investor, so we like to price the round. We like to take a large investment or a large ticket out of the whole investment round. We take board seats. And this is all because we run a concentrated portfolio, fewer companies than some of our peers do, with the intention to really help and put our weight behind those companies. Now, the reason why is that life sciences and digital medicine, which is something I'm focused on, is still a regulated space. You're making inferences on people's health. And so you cannot just go about and, as Facebook says, move fast and break stuff, because you will break a person's life. And so there are safety valves that you need to, there's hurdles. You need to make sure that you walk the right path. That's what we have done for 50 years. We understand life sciences, we understand healthcare, and we have got the channels. Think of the biggest pharma companies in the world. At least a dozen of the biggest pharma companies in the world are represented on our platform. At least on the payment side, some of the biggest payers. On the infrastructure side, we have very tight relationships with some of the biggest infrastructure players. So we can very early on in the journey create a strategic dialogue and see, portfolio company XYZ is developing this product. What does a potential big pharma player think of that? Of course, always a mutual consent, but we can have that early discussion. And with our knowledge of those channels, with our knowledge of the regulatory pathway, with our knowledge of medicine in general, we can also provide very tailored advice in helping the companies navigate the hurdles adding high value board members, independent board members to their board, getting the advisory in place, etc., etc. And the last thing is, and this cannot be underestimated, access to follow-on capital. That's a big one. It's a big one for any investor, or for any founder, I should say, but also for investors. Making sure that a next funding round can be constructed early on, that the investor who's invested in your company is able to make those connections and help you actually de-risk that journey.
You already covered the next two questions. The first one, I would love to ask anyway. We ask you again now. Is you say you lead investments? Does the leading prohibit you to follow any other leader investors, or for example, do you co-lead an investment?
We can do co-leads. We won't do follow-ons, or we won't do follow investments. Sorry, we do follow-ons, but we don't follow other lead investors. And the reason for that is simple. Look, if we were able to get the required ownership to make our model work and get a board seat, we can, consider a following role. But the reality is that means so much dilution for founders that we don't think that's a healthy start to any relationship. We like to think that we're, founder-friendly investors, that we see this as a partnership. We see this as a journey we're embarking on together. And so by pricing, we are in control of making sure that everybody's incentivized in the right way, making sure that, to take the nautical metaphor again, that the captain of the ship is equally incentivized to reach shore in those new lands he or she is going to, as we are, and making sure that we ultimately have a good, strong dialogue between the two parties, the founders or the C-suite team and the investors. So for us, that lead role is important. And in more often than not being able to lead will, preclude us from doing a deal. But there's always exceptions.
Life is made by exceptions. What do we do to help the startups invest to get the next round of funding? You already have been talking for a bit about, do you get involved, actively involved in the next round?
Yes. Yeah. That being said, having been in this space for a while now, there is an element of the C-suite team still needs to do it him or herself, and especially the CEO. We can provide services behind the scenes, but we will not be in that pitching room with the CEO. That is what the CEO has to do, because that's ultimately the responsibility of the captain of the ship. We can provide navigation. We can provide the right parties to speak with. We can provide introductions. We can have discussions, follow-ups, sort of back channels. We cannot do the pitch for you, and nor should we, because ultimately, if the company that we invest in is going to be exited by an M&A or an IPO, it has to be the CEO that has that discussion, that dialogue. So it is really still the CEO's responsibility, and we will do as much as we can behind the scenes to, of course, help out, alleviate, make sure the pitch documentation is up to date. We have a marketing teams, a comms teams. We have people that can help design and shape those pitch decks. Of course, we can do all that, but the ultimate execution still lies with the CEO.
How do you expect your investments to help your portfolio? I mean, should your portfolio companies have interaction in some extent?
You mean between the different portfolio companies?
Yes.
Yeah, of course. I mean, that's the beauty of digital medicine. Like, for instance, you can think of a company that provides a software solution for clinics, and then another software company that is doing higher accuracy radiology inferences. The two match very well together because one provides market access and the other one provides a valuable product. So together, all of a sudden, you have market access and value generation. It's on a case-by-case basis, and it's also, to a large amount, driven by the need of the company. We will not force any company into a dialogue should they not want that. But it is, of course, an additional service that we provide where we can sometimes say 1 + 1 is 3. The other thing that we do, a very concrete example, our platform has quite a bit of scale. There's a massive benefit to that. A very concrete example, we have AWS rates that basically we provide to our portfolio companies. So you actually get your computing power and your cloud storage at a cheaper rate than anybody else could offer you at this point. And that's simply because we get those benefits from the simple scale that we have on the platform. So it's small things like that that all added together actually provide quite a bit of value.
Oh, I do believe so. I mean, having interaction can only be good in many extents. What happens if they fail? I know you don't like this question.
There's nothing wrong with it. It's the model. Hopefully we fail early. It's look, venture capital is a power law based business model. So, you know, out of a portfolio, only 5 to 10% will ultimately really drive the returns. Then maybe another 10 to 20% will drive medium returns, and the rest will basically not drive a lot of returns. There's nothing wrong with this, and we work with repeat entrepreneurs. If we all agree that, you know, this is a company that ultimately does not fit the return potential that we have, and maybe we decide that the company fails, we don't hold it against anybody, because again, it's an agreement that we both signed in a business model, in a financing plan, and we said this is the required endpoint for a next funding round. If that's not reached, you know, back to the drawing board.
This is personal. Why did you become an investor?
Yeah. I think I told you before, right? It's simple. It's lack of a better idea.
Yeah, the webinar.
This is a brilliant industry, because I get to work with many people who have great ideas. I get exposed almost like, you know, like a child with a new toy every day. So I feel very privileged. If I had the $1 million idea myself, I would have done it. But at this point, I think this is just brilliant to be able to work with founders who have good ideas, try and engage with them in understanding what risk versus rewards there are, and how to ultimately bring something forward that could be very promising. Now, this is actually an interesting thing that I think we should emphasize. The partnership between venture and founder, between venture investor and founder, for me, lies in the following. We will not say that we are super specialists in whatever niche of science or whatever niche of engineering that the particular team is focused on, nor can we be, because we can't know everything of everything. But what we are is specialized generalists. So we provide, within our domain of healthcare, within our domain of life sciences, sort of a meta view. And we therefore have a lot of data points, much more horizontal than that a founder would have, where the data points are perhaps much more vertical, much more deep into a particular area of expertise. And that marriage between the two parties, one saying, I have a very specific but very broad view in a domain, and the other one saying, I have a very specific and very deep but narrow view in a domain, that ultimately can be a fantastic marriage if the dialogue is had in a constructive way. And that's really, in my view, what the best sort of like marriages, for lack of a better phrase, between venture investor and founders are made of.
I mean, I'm sure you see so many decks and pitch per year, uncountable. Which are the critical points that trigger your decision ultimately to invest?
I don't have a silver bullet answer for you, because that would also trigger a standardization that takes sort of like, you know, variability and pluriformity out of it, which is actually the most beautiful thing. Like that, sometimes we see a fantastic pitch deck of 30 slides that is maybe deeply technical, that we say like, well, it's a great pitch deck, but ultimately it doesn't capture what we need. And sometimes you see a small teaser and you're like, damn, I need to speak with those guys. This is cool. The form of what we're looking for, what I'm looking for, is first of all, any technology that has global potential. Now, and this is personal. There's other investors with different strategies, but for us, it needs to be global potential. The only way that we can see technologies being global is if you play fundamental biology. Because think about it. If you take ibuprofen, you take it in San Francisco, you take it in Iceland, you take it in South Africa, it has the same effect. So we're doing the same. We're looking at technologies that play fundamental biology, because it's the only common denominator that we have across our globe. Then the second part of it is, the second thing we're deeply looking at is, what is the competitive advantage? And again, I look at data plus computation in medicine. So we look at, for example, data that is generated and closed in a closed loop feedback loop is fed back into a model. Because with a lack of being able to put intellectual property on any on any algorithm, we are now able to say, okay, you're actually trained very deeply, very specifically, your algorithm on proprietary data. Then the third element, the third part of this is a platform potential. So having the ability to generate multiple revenue streams. And then, the fourth part is, and this is particularly important in medicine, evidence. If you are saying that you make a claim for, I don't know, having people adhere to drugs better, or having, for example, people concentrate better, can you quantify that? Because only then can you unlock the so-called gatekeepers in medicine, which are oftentimes the physicians and the insurers. So for us, global potential, evidence, platform, and being able to have proprietary data sets.
I mean, to the founders still talking about pitching, what is the perfect recipe for a great pitch, if there is one?
Again, if I knew, I would have probably found my own company and hopefully be on NASDAQ right now. The classification that's important to note is that we are pitching every single day ourselves as well as VCs. So we're always asking for money, maybe even more so than founders. So again, if anybody has the recipe, please let me know. I'll be very happy to hear that. So what is very important is being able to describe the big picture, being able to describe the technology, and then again, sort of like go back to what is the big picture. Now, what I mean by that is, it's almost, if you think about a train of thought as an actual vector, a lot of founders go very bottom up. They have a technology and they'll describe what the technology can do, and then sort of like that's the end. What we need as venture investors is understanding what a technology can ultimately be in a commercial setting. So we come at things very top down. We come at it, okay, so what is the potential in the market for this? Where can you go ultimately? And how can this technology get there? So for me, having that mindset, being able to say, with this technology, we can go all the way there. That's the vision. Now, how are we going to get there? And how are we going to do that? What is that journey going to look like? That's very important and helpful in order to have a constructive dialogue, because ultimately that's the journey you sign up to.
I mean, how important is that? You are in healthcare, so for you probably it's very important. But how important is that belongs to the startup to capture a venture capital investment?
If you are in therapeutics, it's super important. If you are in medical devices, it's super important. In software, where algorithms are written to ultimately have a therapeutic effect, it's very hard to patent a piece of code. So if there's two ways to think about IP, right? You have almost like offensive and defensive IP. Now, if you think about therapeutics, you want to make sure that not only do you have a defensive mode, so you have your actual composition of matter, there's also freedom to operate. So you need to be able offensively to make sure that whatever it is that you're going to do, that possibility is there. In software, the only thing we really truly look at is freedom to operate, because defensive IP holds no value. And so what we substitute for that is those proprietary data feeds that I was talking about earlier, making sure that you have an algorithm that is trained in a way that no other player on the market can, because you have generated evidence, you've generated data that ultimately is validated through the machine learning algorithm once again and again and again, and thereby creating distance.
I mean, I used to talk to many founders, and I always say them, there is a way to fund bootstrap your startup, go your own, and there is a way to ask money for venture capitalists. Now, they're very different, and the mindsetting is completely different. May I ask you, what's your suggestion to these founders, how they should be prepared to approach the venture capital?
I would say venture capital is not a goal in and of itself. We are a tool. And just as lending, private debt is a tool, just as going to a bank for a bank loan is a tool. So for me, you always, or I would always look for framing it from a utility perspective. In other words, what is the ambition? This is a question I always ask to any founder I speak with. Like, what is your ambition? Where do you want to go? What is in it for you? Because if the ambition is to just make 3 or 4 or 5 million or to live well. You know what? Maybe taking a bank loan and growing slowly is the right solution for you. It can provide a good life. You can have a fantastic, time and ultimately generate a lot of value and a lot of wealth personally. But if you want to build something bigger and you need that rocket fuel, venture capital is rocket fuel. It burns super fast, but there is and you can go to a lot of places, but you have also an imposition of growth on you. So we will request our founders to scale, let's say in 5 to 7 years to, I don't know, 50 million revenues if possible, or north of that. That's the ambition. That's what we're signing up towards. So it's literally to the moon. If that is not possible, if there's no way to achieve that, then maybe venture capital is not the right thing for you. And there's nothing wrong with that. There's nothing wrong with saying I will just build a solid brick and mortar business. Maybe just to round that off. Of course, venture capital backed companies are everywhere in sort of like in the limelight. Every other day you hear about SoftBank writing another check in this company, that's that unicorn, such and such. But the way to look at that for me is venture capital, again, is not the end goal. It is a way to achieve a goal. And once that goal is defined for you, you can then understand what are the particular elements of the equation, funding in this case, that I need to put in place.
I want to close with this one. What's going to be the best sector to invest in 2022?
I mean, I'm biased, of course, but equally, I'm actually a really firm believer in this. It's going to be healthcare technology, digital medicine. And the reason is very simple. We see the percentage of spend of GDP on medicine increasing drastically. It's gone from about 8% to 17% of GDP in the US over the last 20, 25 years. Yet we see the demographic pyramid changing. Now, that means that there's fewer people to foot the bill and more people in demand of healthcare. So the mission that we're on is to keep healthcare affordable, to make sure that the system as we've built it is not breaking. Put over that a source of climate change, and you can see that there's going to be all kinds of drama coming for humanity. So equally as climate tech impact and all that stuff is really necessary, and I'm very happy to see the amounts of capital flowing into that domain. I think healthcare technology, digitization of healthcare, making sure we catch diseases earlier, making sure we treat diseases more efficient, making sure we keep people productive for longer. That's fundamental. And we need to make sure that therefore we enable that. So for me, if you look at the different areas of investment, healthcare technology is definitely one of the hottest right now and one of the hottest for 2022.
Edward, thank you very much for coming to the Investor Talk. It's been a very pleasure for me. Thank you so much.
Likewise, Max.